Welcome back to the next session where we were discussing about the nominal interest rate determination with the Taylor rule, and we augmented that with interest rate smoothing, and we also saw that why central bank does not go for increasing the rate of interest with a big or big amount, because, or you can say, big basis points increase, because it will shock the different agents and different segments or different compositions of the economy. And we also saw that this creates the good impact. So we saw in the last session with example that when rho is equal to 0 and rho is equal to 0.8, we are able to pass on the large difference with regard to the previous interest rate more easily, right? And this is what we do. So as I promised that we'll be discussing this part. So interest rate smoothing, why it matters? Because if you are not going for gradualism kind of interest rate adjustment, then this will create a more trouble for the different. For example, we discussed the operation twist, right? Buying and selling of long term and short term yield bonds. So this will impact the yield, and as a result, you will find that gilt edge market will be having some trouble. And gradualism, the gradual increase in or decrease in rate of interest also stabilizes the foreign exchange market, where you have buying and selling, swapping of the exchange rate with fixed and the flexible. So there also it matters. Most importantly, we saw that commercial banks, because banking is the one of the important components for the central bank. So what happens that when we have a when we do not follow the, I would say, gradualism, then this will create trouble for the commercial banking, because what happens that if you have a, for example, in the previous case, we saw that when we are going to have the rate of interest increase by 0.5% basis point, right, then this it creates a big impact, right, or you can say shocks the economy. But when we are seeing 0.1 basis point, then this will not uh, deter the borrowers in the economy, right? So this is what we say. So it means that the if company has already planned the capex, and if it sees only 0.1 increase, then it will not postpone. So postponing will not be a case here. They will go for investment, right? Because they see margin increase in the cost, because they see a marginal increase in cost, right? So this is what here we have. Second thing is that it also creates a good credibility of the central bank, because if the gradualism is adopted, it implies that the central bank is looking for some kind of not giving a big shock to the economy, but rather going for gradual adjustment. So this also gives a good communication based advantage, and also at the same time it increases the credibility of the central bank. So this is where it matters, right? So this is how we discuss. Let's move on. In different countries there are different norms, and in the literature also on the monetary policy rule, there have been different rules of measuring the the monetary policy stance, or you can say in nominal interest rate predictability. Now we have something called nominal GDP targeting. What is the meaning of nominal GDP targeting? So here it implies that here we have nominal interest rate is equal to the neutral real interest rate that we discussed, plus here we have long run trend of the real GDP growth. So this is what it means. And instead of taking the inflation gap and output gap, they just consider the nominal in GDP, right? So this is like output gap. So a nominal GDP in certain countries, nominal GDP targeting is also uh, a policy relevance, and they do not go for targeting the nominal interest rate, rather they go for targeting the nominal GDP, and the deviations from. So what actual this is what the overall, you can say, potential nominal GDP looks like, and this is what the economy actually receives, right? So this is what we get. Nominal GDP, what we normally know that it is the real GDP growth plus the inflation, right? Right. So this is what it gives. So it means that automatically you have the inflation considered once you consider the nominal. If the nominal GDP is greater than nominal GDP growth, it means that it creates some kind of high inflation scenario. So it is same like, let me give you a perspective. It is same like what we discussed, the output gap, right? And if you are saying that when my NGDPT is greater than NGDP T star, then what it implies that it raises the IT, right? Which means that what is the meaning? That this creates some kind of overheating kind of scenario. Same as we discussed in case of output gap, right? And overheating often leads to what we call it as the high inflation, and in order to catch up the high inflation you will have to increase the interest rate, right? So this is what is the scenario, but this scenario is considered as appropriate for economy, because inflation has two roles appropriate for the economy, because inflation has two roles. What is one? That it gives the it at least gives the fair price of the product. So this is what here we have the A. My B is that it also incentivizes the entrepreneurs or businessmen to produce. Entrepreneurs and businesses to produce. So even the father of modern macroeconomics, Keynes, also suggested that there should be mild inflation, not very high, but there should be mild inflation in the economy. Otherwise, none of the businesses would survive and they will go for. In recent time in India, we are seeing that inflation is going down, and it has come down aggressively. And this is also one of the major concerns, that companies and all the everyone is not very much interested in creating more employment, more demand in the economy, because they see a very low price for their product. In case of China, it is having the same kind of trend, whereas the first world is experiencing high inflation. In most of the second world and third world, we are seeing the deflationary kind of scenario. In China, companies are competing so much with each other. Companies are competing so much with each other that they are compromising highly on their margins, and they are ready to sell the product even with very low margin, and this is creating again a deflationary kind of trend. So inflation is always a good indicator, but it should not be so high like 10% or 15%, but it should not be also too low, around 2 to 3%. It will not be good for the economy, especially for employment creation and others, right? So this is what we get. So I hope it is clear that when we target nominal GDP, inflation is implicitly targeted, and when we have nominal GDP, actual nominal GDP is greater than the potential nominal GDP, it will create high inflation, and you should be ready to increase the nominal rate of interest. If you have the nominal GDP less than the potential GDP, which is NGDPT star, which is the potential means how much should be and how much is actually. If it actually is less than the potential, then it creates a, you have to go for cutting down of rate of interest, and this creates further the weak demand in the economy, because you have excess supply in the economy. So this is how we often find. So I have given one example here, that suppose the neutral real rate for India, given that there are no NGDPT and output gap, so it is around 1.5 to 2%. The trend, the real GDP growth is around 6%, for example. So NGDP star is 6%. Actual NGDP is the 10%, and target NGDP growth is 8%, and the theta that we are considering is 0.5. So now we can see that how much we are going to see. So here you can see, if you substitute these values here, then we get that 2% plus 6%. So 6% I mentioned about this. The so G star is the trend, right? So this is what here we have. So I told about NGDP T star, but here it is G star, and the target NGDP growth is 8%. So 8% is this. So here what we have to, I think I discussed this as the potential. So here you can see it is the target. So you have to consider only the target output, which means that this is what the economy should be achieving, and how much is the actual. If you have deviation, if it is greater than this, it means that you demand more, so you have to go for higher rate of interest. If you are having the actual growth rate, nominal GDP growth rate, less than the target, it means that you have less of demand and you are generating less. Then it creates a good impact. It creates a some kind of deflationary trend, and this is what we often find. And let's have the example here. I've done the corrections here. So it was the target path for the policy rate. This is what we mentioned. So computation, if you are going for the computing the nominal interest rate, so it is 2% plus 6% plus 0.5, 10 minus 8, 8% is the target, and 10 here. So if you get the value, it comes out to be 9%. So this is what we get. So actual nominal GDP growth exceeds the target by 2 percentage point. The higher nominal rate, it means that the RBI will have to look for tighter RBI stance, which means that increase the rate of interest. So I will be higher, right? So this is what we get. So I, of how much we are seeing, that if the nominal GDP target is 8%, and if my theta value is 0.5, then my nominal interest rate must be 9%, higher than the nominal GDP target growth, right? So this is what we get. So this is what we understand. So nominal GDP targeting is also one rule as compared to the policy rule that here we have. Then Friedman, which is called also the Friedman, is was a staunch supporter of, you can say, monetary stance. So he mentioned that inflation is everywhere, is a monetary phenomena, and he was also one of the staunch supporter of why monetary policy should be playing an important role. So he was basically a sympathizer of short-term adjustment in the economy, because he always believed that short-term adjustment in the economy will lead to the long-run equilibrium in the economy. So he was a big supporter of this idea. The delta MT, he mentioned that there should be a constant money supply growth. The constant money supply, here we are talking about the broad money, that how much we should have the broad money growth in the economy. So if you read the economic survey, they mention about the broad money, right? So they mention about, so simple and rule based, and he also mentioned that there should be a target every year, that how much should we inject the money supply in the economy. If the money supply injection rate is exceeding the inflation, it means that it is good. If the money supply increase leading to more inflation, then we'll have to think about cutting down. So this was the idea. And he also mentions about, so I hope you all know what we call it as MV is equal to PT. We also mentioned this earlier. So the idea behind is that whatever money supply or monetary value that you are creating, it must be equivalent to the transaction with prices. If you have a deviation happening, then it means that you have a you create either excess demand or excess supply kind of scenario. So this is directly or indirectly linked with inflation, that We know that when money supply increases, right, we see a price level rise, right, because a rate of interest comes down and this creates a boost in the economy. So how much we are seeing? So if you are having 8% and inflation goes, suppose it was 6%, but now because of the 8% increase is 10%, then we have to monitor that how much you can tolerate, and accordingly we will have the adjustment in the money supply. So this is what here it mentions about. Then Wixel, who is called the father of the interest rate theory that we read in most of the textbook and the macro, he was big supporter of interest rate based economy, and he also suggested that interest rate is nothing but the reward for holding the money. So he was one of the strong supporters, like Friedman, who was the major supporter of the monetary idea. So what he mentioned, that your nominal interest rate is nothing but the real interest rate plus the current inflation. So this was the idea. And he mentioned that if the nominal interest rate is less than the nominal interest is less than the real interest rate plus inflation, then we will have to go for the expansionary kind of policy, right? And if it is higher, then we'll have to go for contractionary. What it means that, as I mentioned, that let's break down this further. So here we are having RT star is equal to, we can also write this as IT minus pi t, right? So if you remember, I discussed this, what we call it as the central bank credibility. I think I remember I had discussed this. Central bank credibility, right? What is the meaning of it? Meaning of it is that as long as the RT is greater than all this, the difference of this. So as long as RT is greater, sorry, as long as RT star is greater, right? Maybe suppose the nominal interest rate is, you have kept money in the bank is offering you 5% and inflation is 4%. So here you have no real interest at 1%, which means that in reality you are getting 1% higher than the inflation. So you are able to hedge your inflation. But in real life, it is not the case. If the RT star is less than 0, then this creates a big trouble for the central bank. Credibility, right? Now, what is the purpose here? The central bank credibility, what it means that it helps you, or it incentivizes is the common people, or you can say, I think instead of this I can write that the appropriate sentence will be that it makes the banking sector relevance. It makes the relevant, right? So this is what we get here. Now, in most scenarios, this is also called the Fisherian kind of equation, wherein the nominal interest rate is equal to real interest rate plus the current inflation. But what was the idea behind that? If you have the real interest rate positive, then it is always good for the economy and good for the central bank credibility and monetary policy credibility. So it was also relevant for quite a long time, but now everyone has moved to the Taylor rule. Then we see a recent development after 2008 global financial crisis, that they have gone for augmenting the Taylor rule with something called financial a gap, or you can say credit gap, or you can think about any kind of gap that you can understand. For example, if you are targeting a real estate, then it could be the dwelling prices, the housing prices. If you are targeting the bank, then it could be the debt plus the actual debt demand. So this could be also credit gap, which I mentioned about. So any kind of you can think about the prime lending rate minus the targeted prime lending rate, or maybe the potential demand of the prime lending rate at which the banks lend to the individuals, or you can simply consider the credit gap by taking the call money rate, right, which means that CMR, interbank borrowing and lending. So how much is the spread, so that you can also consider. So you can see over a period of time, as the economy had more complications, we see that the Taylor rule is also expanding with more terms. But what is good about this is that it is having a reduced form setup. So if you are interested in econometrics or maybe the statistics, you can run the regression and find out this is not identity, this is equations. Equations can be estimated, right? And theta pi and theta y is in that respect very easy. And then here we have r star, this we consider, and here we have pi t, and theta pi and pi t minus pi star is this. So this is what we also mentioned about. And here we have we see that because of this augmentation, the debate on what we call it as the whether the tool remains relevant for the macroeconomics, or it is going for the macro potential, which means that oversighting, risk oversighting, and also this is also one of the important recent developments that you must know. So because of that, I have mentioned here. There is also a debate about, as I mentioned last to last sessions, I think, where we discussed about the persona of the central bank, whether he is conservative, so whether he is hawkish on inflation or dovish, right? So the Kenneth Rogoff suggested that if the central bank governor is appointed who gives more higher weight on inflation stabilization, then what is the average expected inflation rate, then it brings a good amount of control on inflation. So this is also good for estimating. So it means that if you know the behavior of the central bank governor, that whenever the central bank governor sees a rise in inflation, then central bank governor will react and it will try to control the inflation, and it may be a hawkish kind of scenario. So then in that case it becomes really important. So this is what here it makes. And there is a lot of, you can say, Rogoff idea was suggested in line with what one can think on different types of the parameter values, but it is still more of like behavioral kind of understanding about the policy setting and or policy predictability. But still it has relevance, because in a lot of countries it has been noticed that the inflation management becomes after some time a case for persona of the central bank governor, how he is. So let's summarize. So here we augmented the normal Taylor rule with the interest rate smoothing or inertia. Then we also targeted the nominal GDP growth. This is what we also had. Then we had the Friedman. We talked about the monetary policy and velocity circulation of money, how quick it is. And Wixel, which mentions about the rate of interest, that how rate of interest can be playing important role, and it is more or less linked with the Fisher idea. And financial objective, which is linked with the macro potential. So this is how we discuss. Now, this particular course is about commercial banking. So let's shed a light on how Taylor rule is related to commercial banking. So this is the typical the Taylor rule that we have already seen. So what is the understanding that it, given the inflation gap and output gap and the neutral rate of interest and the target inflation, it basically gives you the idea that what should be the nominal interest rate. But there is a concept called monetary policy transmissions that we'll be discussing maybe in next week or maybe next to next week. And there, what we mostly focus on is that how, with the change in the policy rate, we know that whenever we see increase in repo rate, which is the policy rate here, it has pass through effect on the lending and deposit rates. Then when we see a policy rate decline, then we see lending and deposit rates coming down. And what is the effect? Effect is that the credit lending rate uh, goes up. So marginal credit lending rate also goes up. It also has a role on deposit rate setting. If the central bank is reducing the rate of interest, the you will find that all the banks will be also cutting down on their deposit rates. So individuals will be getting less return on their deposits in the bank, and especially for pensioner and old age people, it becomes a burden. Maybe the young generation, young people may be moving out and they'll be investing, but everyone will not be. And it, you can say, it is also not suitable for the risk averse investor, I think, in a simple way, if you want to say. It also impacts the treasury operations and bond yields, because if the rate of interest is going to be lower, then you can see that the yield will go up, and as a result it creates a bad it also so when you have the rate of interest going up, you see bond prices will be also shooting. But if the rate of interest comes down, then bond prices will be also having the so previously issued bond will have more prices in the market as compared to currently issued if the interest rate is lower, right? So this is what we often see. And we find that the Taylor rule prediction, it also helps you in terms of understanding that how the banks are going to react. So this is where it is very, very important. Now here again, if you think in terms of what should be the role of Taylor rule in the commercial banking, so you can think about the balance sheet channel, which is like when we have the high policy rate, it impacts your borrowing and lending, and as a result, you see a higher cost of fund, and you again see a lot of projects getting not that much. So because if your IRR is suppose 8%, your borrowing is 10%, the project becomes unviable, right? Because this is what we often get. The credit channel in the sense that once we have the stabilized inflation and output gap, then this also create if you have high interest rate, we know that the borrowing will be lower, and this will further create the trouble for the banks, those who are going to lend. If they find that the interest rate scenarios given the macroeconomic conditions are not good, and if they are not lending to even good borrowers, then this creates a whole lot of impact on the economy, right? And this is where we find if the in inflation scenarios are not up to the mark as per the expectation, then this will further create a burden, and this will also be putting a check on borrowing and lending scenario. Expectation channel, which means that how much we can go for role for the in inflation expectations, whether can we also look for some kind of rule based scenarios where we can think about. So this is how it mentions, and overall it also creates the market discipline, and this is where it is very, very important to understand. So this is what we get here. Now I also wanted to mention that when we discuss about the policy rate, right? So here in monetary policy scenarios, what is the most important case, that whenever we have the policy rate going up, so this we mentioned. And what we often see, I think I discussed about the treasury operations. So this impacts the treasury operations. So this you can say about the operation twist kind of scenario, right, where buying and selling. You will be also knowing that when we have the rate of interest higher shooting out, bond price comes down, because People will be selling the current bond and moving to the new bond issued because it will be offering higher rate of interest. And you know that if the and yield is nothing but price of the bond plus the rate of interest, right? So if the rate of interest is higher, your yield is lower. If the rate of interest is lower, your yield is higher, and this is what we often link with the Taylor rule. The second aspect is about the NPV and IRR. What is IRR and NPV? So IRR is the rate at which it is the rate at which your NPV, net present value is zero, right? So this is what it implies. So if you have the rate of interest suppose going up, right? So for example, I is higher, then you know that this is nothing but, so present value is what? How much is your, so future value is what? PV into 1 plus R. So what is PV? So future value upon 1 plus R. What is your present value? So present value is what? How much you are getting. So suppose my your NPV is what? Initial investment. Suppose my investment is Y, right? And my cash flows are Y1 upon 1 plus R plus Y2 upon 1 plus R square and so on, right? So this is my initial investment, how much I am getting. So I have to solve for R, and that's why our IRR calculations are quite tricky, because I have to solve for this R. What is this R rate that we are considering? So this rate, if it is higher, then you know that your overall value is going to be lower. If it is lower, then it is going to be higher, right? So this is what it implies, that overall when you are going for and considering a project, if the rate of interest is higher, your borrowing cost is going to be higher, and a lot of your margin will be eaten by. For example, if your IRR, suppose based on this calculation, is coming out to be 10%, the market is offering you the loan at 8%, it means that you have the spread of only 2%. But if the rate of interest is again higher, the spread comes to 1%. Now you have to see that whether this project is viable or not. So in that case, it is very, very important. Expectations play a very important role. I think I have already mentioned about that, how it impacts the overall borrowing and lending scenarios. Household inflation expectation survey available on the RBI website also gives. It is based on both adaptive expectation and rational expectations. But in India, in most of the cases, we find that adaptive expectation play a very important role. So with this, I am stopping it here. I hope you like this session. We'll be discussing a different macro setup in the next session, which will be mostly about how to determine the monetary and fiscal policy interactions. And in the ISLM setup, we'll try to see. So with this, I am stopping it here. Thank you. Thank you so much. I appreciate.